All right. Good morning, everyone. Happy Sunday. It's 11:50 a.m., April 26th. My name is Amal, and I have our equities analyst Faisal on the call as well. Today, we are going to discuss all things related to coronavirus, what's happened in the last week with oil, J.C. Penney potentially declaring bankruptcy, Brazil, stock market and currency in free fall, and many other things. Okay. So first things first, I want to welcome Faisal.
Hey man, how you doing?
Not too bad. It's been an interesting past week, and I'm glad I have you on the call to discuss all the things that we need to look at to warn our viewers about what we're seeing in the markets as well as what we're expecting for the week ahead. So I hope you're ready, man, because I think it's going to be a really interesting conversation.
Yeah, dude, it was a crazy week on all spectrums of the market, so I'm glad to get into it right now.
All right, let's do it. Okay, first things first, folks. Again, the United States still leads in infections and death count. I think we're closer to about 44,000 or so. I haven't found an exact number of where we are, but this is one of the Financial Times charts that has data that was updated about April 25th, so just yesterday. Um, and so you can see this is pretty much the, the daily average cases as well as the death count. Okay. For the most part, I think we all agree that the United States clearly leads in the infection rates as well as the deaths. And now that we're kind of just starting to flatten the curve, Faisal and I were just talking about how it's almost ridiculous that we are just now starting to flatten the curve, yet we are opening up the economy without even having mass testing out. What are your thoughts on that, Faisal?
Well, personally, as a human, I think that's pretty crazy. Here in Texas, we are already gearing up to reopen um, a pretty big chunk of our state economy, along with Georgia, and really trying to get back to business as far as getting haircuts, getting a lot of the close contact businesses open again. So I haven't even. I don't think in Houston we've really done that much testing. I think we have tested a fair amount, but it's not to the level where you would think close contact businesses would come back. Um, I think for the most part, it's just presumptive, and it increases the long term risk that could happen as far as the disease coming back and maybe even a second wave. Um, Coming into the state worse than the first. I don't think that's out of the realm of possibilities. So just doing this increases the risk, but I think overall it'll be looked at in the short term as a positive more so than a negative.
Yeah, that's a great point, and I'm glad you mentioned Texas opening up because I think one of the bigger states that everyone has their eye on is Georgia as well, which has kind of been on the front page news, especially in the Trump conferences about how they're starting to open back up pretty much at a larger scale, more so than other states. And I think it's going to be a state that we want to watch because Georgia, Texas, some of the other states that are opening up, these are going to be your trial and error kind of states because you're going to get to see how these states react, what kind of maybe possibility that we can expect from other states opening up in terms of their economy, what kind of revenues that businesses see, and possibly you might see maybe an increase in either the infection rates or maybe even the deaths. Unfortunately, I mean that is something that we have to expect. So, I'm really going to watch Georgia and especially Texas closely, especially Texas. I mean, because it's such a large business hub for being one of the largest employment states, not only in the energy sector but in the tech sector as well, due to Austin, Dallas, and Houston having a lot of different tech jobs as well. So, just something that I'm going to be paying attention to. Now, going off that, Faisal, the one other thing that we spoke about is what was it, unemployment, right? Now, Texas, Georgia, be it any state, I mean, no one has really been immune to what's happened in terms of the real economy. Okay. And this is one of the links that I pulled up, which is layoffs.fyi. This actually tracks some of the small startup businesses that have started to see layoffs, come through in terms of their business. And you could see across the board, I mean, a majority of business, whether you're a dentist or you're in the sales area or you're in tech, clothing, marketing, service industry, et cetera, every single industry, no one has been immune to layoffs. And last week we saw another 4.3 million people get laid off. So that brings us to around total about 26.5 million people that are laid off. What are your thoughts about, the timeline for recovery, and how do you see small business layoffs versus, large corporations? And also, again, just regarding the recovery.
It's really right now up in the air. When I look at the market has so much strength in it, even though I consistently think that it's going to go down because this crisis is obviously, I don't think that we're close to even being done with it. So my presumed thing is to think, okay, when we go up to a certain point, I expect there to be a good amount of sellers and the buyers to start to deflate a little bit. But so far, it just seems like you have a consistent amount of buyers in this market every single, like at every single level, and they're holding up all the support levels. And I think it's because partially different from this recession versus the last recession. One, even though there's a ton of people getting laid off, just as you mentioned, unemployment benefits are pretty damn good right now. Like you can make a good amount of money in the short term. Like obviously you may still have some strain, but it's not like I think how it was at the 0809 recession. I think banks are a lot healthier. There's just so many better factors. Like we're even seeing it with consumer demand. Like take for example Chipotle. Okay, Chipotle is a company that should have seen massive strain in their business as far as supply chains being rippled a little bit, and definitely consumer demand not going into their stores as much, and obviously losing some of that traction. Their stock went up. Go ahead and pull it up. Yeah, CMG. Their stock went up, I want to say 10% on the earnings day earlier this week off of really high digital sales and everything like that. So you're still seeing relatively a strong consumer for a recession. And I think that bodes very well for how the market is doing right now. And I think it's one of the reasons this market is doing so well right now and continues to see buyers at every level. The unemployment situation is one of those factors that really keeps this market on its toes. I think it's tricky to kind of guess when unemployment becomes too much and when it has been priced in. But so far, I think the market is pricing in a lot of good factors in relation to other recessions. And I think it just goes to show you this market actually has a lot more strength than I think we previously think, despite us, in my opinion, being in a recession right now.
Yeah, and that's a great point that you mentioned about the market strength, kind of going in face of all odds of what's happening in the real economy, where we see bankruptcies piling up, we see bonds being downgraded, and then we see unemployment, of course, now at almost 17 to 18% of the total labor workforce, which is around 26.5 million people. It seems like the market has completely just ignored everything that's happening in reality, and it's just saying that I'm going to do whatever I need to do because the Fed itself has completely, gone into the market and told people that we're going to backstop pretty much everything in the bond markets, whether it's junk bonds or investment grade. They're going to also start tapping into ETFs, which is also something that I heard. So it seems like managers across the board, hedge fund managers or institutions across the board, are probably just looking at this market and saying, well, we've learned our lesson in history of never fighting the Fed. And now the Fed has basically come out with, a rocket launcher saying that any selling will pretty much be absorbed, or, we're there to backstop it. Mm-hmm. And that kind of goes to show, of course, the market is going to move up, right? The Fed has trillions of dollars of a war chest, and that's not something that you can fight. So it seems like though the market is going up, it doesn't seem like it's going up due to significantly oversold conditions, or it's not like the market is irrationally, priced. It's rather that it's distorted and, in a sense, manipulated, because the Fed is effectively saying that we're just going to buy everything. And no matter what, we're going to make sure that the stock market itself doesn't go down significantly. And that's like their litmus test or their barometer of how the economy is doing in terms of its success, which is clearly wrong because, I mean, the success of an economy is not derived simply from a stock market. It's obviously, in terms of the GDP or the unemployment rate of a country. And of course, part of it is the stock market and the currency. But right now, their only barometer is we need to make sure that the market is up. So do you think that distortion of the market itself is healthy? And if so, I mean, how do our viewers or people like you and I kind of look at this market and say, well, at some point we just got to start being bullish with the market?
That's a great question. I wish I could tell you the 100% answer, but I really don't have any idea as to what exactly the market will try and price in the future. I will say that given your distortion comment, I don't know if it's necessarily distortion that's pushing this market up rather than a lot of risk being taken off and a floor being put in by the Fed and in the bond market as well as the stock market. I think, like you said, institutions do not fight the Fed. And when the Fed has said, we are going to make sure you all get through this, I think that removes an enormous amount of risk, because in hindsight, the virus is a short-term issue. Like, let's be real here. Like, the virus will be a short-term issue. Medicine and science will end up coming through and hopefully can make some great progressions as far as vaccines and therapies. And you have to think about the timeline. Like, people expect at most the vaccine will come out in 2021. Okay, when we get a vaccine, what do you think will happen? How do you think people will start going about their day again? Because before this entire thing hit, the economy was doing fairly good, and I think it was just on its way to having another really good year or 2-year growth period. But it's all about pricing in the unknown and known. And I think as time goes on, more clarity comes to both of those sides, and more unknowns become known, and that gets factored in. And I think as time has gone by since we've sold off 30%, it's been a lot more optimistic as far as the Fed coming in. Unemployment benefits are really good. Like, I really think that is helping a lot of people. And if people start returning back to work within the next week or 2 weeks, I think the amount that they got from that is fairly good. I think they were able to keep off that. But if this lockdown gets extended to, let's God forbid, another 3 months, then I don't think, I think that'll become a serious issue. But as of right now, with what we're seeing from Texas reopening and other state governments saying they want to reopen, I think that's all optimistic news for the market, and it's being priced in as, okay, the worst is coming to an end, and now we have to start pricing in maybe a very strong consumer and, global growth starting to get back on track. So I don't know if it's just, it seems distorted right now when we look at everything right now, but remember, the market is a discounting mechanism. It's going to discount 1 year, 2 year, 3 years, depending on where we're at. So that's what I think it's doing right now. And so it's really tricking a lot of people, including myself.
Good point. Good point. I wanted to talk about how the market itself, scored off with oil last week, because obviously we saw something historic in oil last week that pretty much no one had ever seen before, which were negative prices in the May futures contracts. If we look at that previous contract, you could see that it pretty much, dropped off all the way to, I guess it was like $42 or so, right? And then obviously it climbed back up the next day, but the next day the contract itself was pretty much closed. And now we're looking at the June futures contract, which, as we were discussing on the call before, I don't see any reason why the June contract cannot also be negative, given the fact that it's not like things in the economy have changed. We still have a dismal demand from consumers across the board, or companies, airliners, cruise lines, etc. Right? So the oversupply is still there, right? The storage facilities are also getting full. companies across the board are still pumping out oil given the fact that we still have really no demand, or rather not as much as we used to. And then I saw this marine vessel tracker where you could see these are all the oil tankers that are parked right near the southern coast of California, and they're just waiting to dock. But I think the docking facilities have effectively said that, hey, we don't really need oil right now, or nor do we have a place to store it. And you can see across the US, there's so many of them. And I can't definitively say they're all, just waiting there and not allowed to dock or offload their oil. But you can see here's the case of the entire world, right? You can see the entire world. And these are all the oil tankers and the vessels that are just moving around. And given the state of the world, you can realize that there is so much oil that's just sitting out there that is not being used at present moment. So how can things quickly change in June? And it just doesn't make any sense. What are your thoughts on that?
Exactly what you said. I think if you, like, this is my own opinion, this is not financial advice or anything like that, but if you are in futures contracts that expire in June, even though you've seen a nice bounce in the last week as oil is risen up from being negative, these contracts will probably, in my opinion, go down to below zero before the expiration date. You know how this week it literally waited till the day it was supposed to expire? No. I think now that people understand how severe the storage is and how much it actually costs some of these buyers to store, to maintain this storage to the point where they actually have to pay someone else to take it off their hands, I think these contracts could trade at -10 future, or -$10, and then end up going to -100 by the time they expire. I mean, I think the range in which these things can trade in has been altered forever, especially as long as this storage problem continues to plague this industry. It's like, be ready for negative prices consistently. I think at least June and maybe even July.
Yeah. Well, I wanted to mention one of my posts on Twitter. And folks, if you don't follow us on Twitter, please do, because Faisal and I have really amazing conversations and discussions about all things related to financial markets. And we put up our thoughts on the Twitter page, even on the Medium page or TradingView. And one of the thoughts that we had about oil, especially last week, was a lot of your friends, or even my friends, have started to message me about, hey, how do we quote unquote trade oil, right? Mm-hmm. And I think some of them were actually thinking of getting into the futures contracts, where I had to explain to them that, first of all, an average futures contract is about 1,000 barrels of oil, right? So if you're stuck in somehow the contract nearing expiry and you're stuck with holding that contract with no buyers on the other side, you have to legally accept 1,000 barrels of oil. Like, that is a legal contractual obligation. Now, on the other side, if you want to just speculate on oil, there are tons of ETFs, specifically the USO ETF, which has garnered a lot of interest. So my friends were asking me about, what is this USO ETF? And it's actually listed on Robinhood. And again, a lot of the people I know, some of my friends from college, they're really not that astute of a trader. They're not, great investors. And they're definitely not privy to information in the oil sector that Faisal and I may not be aware of. So what we know about oil is clearly that there is a lack of demand, there's huge storage issues, and there's an oversupply, right? A supply shock or a demand shock. So the USO ETF actually right now contains about 30% of the June futures. Now, just as Faisal explained right now, we have pretty much dismal demand of oil. And so the June futures don't really change that, because their pricing is still reflecting that there is still, demand like we used to have, pre-COVID, or at least, demand enough to keep the prices where they are, which personally, I don't think that's the case. And because the USO ETF owns about 30% of the June futures contract, it is very possible that the USO ETF could go to zero, especially when the June futures contracts dives down towards $5, zero, or negative. Now, this is a chart from Robinhood showing you that here are the amount of users holding the USO ETF right now. And this is a scary thought because what you realize is that a majority of retailers are still net long, okay? Because they do not understand, first of all, how the oil markets operate. And they are thinking that, well, oil at some point is going to come back. I'm just going to hold this thing, and what USO is going to 2x or 5x or 10x. But in fact, it could actually go to zero. And there's a very high possibility that it could go to zero because the ETF itself does not represent anything regarding to oil. Okay, so Tasso, do you mind unpacking that and let me know if I missed anything?
No, I think you hit the right points correctly. It just kind of alludes to a very key point you have to remember if you're going to invest in ETFs. Know exactly what is in that ETF, because remember, an ETF is basically a portfolio of assets. Most ETFs that we kind of talk about here, they're mostly comprised of stocks, but there are a couple ETFs like USO which do have, like almost said, they account for 30% of the June contracts. That is absolutely, first of all, that's terrible portfolio management. That's insane. And then secondly, like that itself sets it apart from any other ETF that you may think. So while if your process of thought was to buy an oil ETF because you're under the assumption that ETFs are generally safer than buying, an asset or an oil equity or a futures contract, um, you kind of got caught in a bad light, because this is one of the few ETFs that actually holds future contracts. And even worse, they hold the most near-term contracts, which, as we've talked about, have significant risk, enough risk for it to go to negative 50, exactly like we saw last week. So I still think, yeah, just like you said, this thing is probably going to end up going down. I think it's the the risk of how many retailers are in it and how much people are actually holding on to it for the long term, I think is very, it's only a matter of time until people realize that it's not going to be going up anytime soon, and that the volatility to the downside is just too much to handle. And so once those retailers start dumping, you're going to see one more heavy spike down, and then what happens to the ETF is uncertain from there, in my opinion, whether it gets delisted or something else. But yeah, that's the important thing. But I want to also say, in regards to playing oil, you guys were right. If you actually bought on that, that terrible day, you bought USO because you thought maybe oil was short term oversold, or that was a great time to get in the long term. You're actually right. Oil went up for the remainder of the days, and it actually closed up. Those June futures contracts, the low was $8, I think, for crude, and they closed up 14. So that's almost 100% gain. And if you guys were listening to my oil equities updates or oil updates, the stuff that I do on the Discord, I had been telling y'all the day oil sold off, I said, I bought some actually that day. I said, I like this fear in oil. I think short term, it's way too oversold, given how much fear we're seeing with the negative contracts and all that. If you had bought XLE, which is exactly what I said to buy, it actually closed up 8% for the week. So you would have made an 8% gain versus losing, 50% in a USO. Both of them are ETFs, and both of them are plays on oil, but one is directly comprised of oil equities, which I've been telling people that's the way to play oil, not futures, not any other way, just oil related equities, versus buying something like USO, which has, I think they do have some equities, but when you make up 30% of the June contracts, it like that'll weigh you down. Let me tell you that's definitely going to weigh you down entirely. So I think this whole experience has just showed me definitely how tricky it can be, and how even though you have the right mindset and you may have the right instincts, knowing what tools to invest in, what instruments to invest in is just as key as having the right hindsight in the first place, or having the right vision in the first place.
Yeah, that's a really great point that you mentioned, and I do want to point out again, folks, for the viewers who are viewing this right now, Faisal mentioned XLE multiple times earlier in the week, and then even Friday itself, he had mentioned, how his XLE pickup was up another 2%. So just as Faisal mentioned, it's not only important to understand why things are going up or down, or when something is a good buy or not, um, to position yourself in terms of the timing, as well as understanding what product you're buying is going to be impacted by how the market moves, or rather in this case the oil markets. That is critically important, because it's very well possible that the oil contracts for June did go up like they did right here, but yet the USO ETF actually went down, as you can see. Okay, so it's critically important for you to understand exactly what you're doing in this particular sector, or any sector. And this is why Faisal and I provide you the information that we do on a day-to-day basis. Okay, so I hope you guys give us a thumbs up or subscribe to our channel, or join the Advantage membership so you can get updates like this from Faisal and myself. Now, I'm actually on the other token where, whereas Faisal picked up the XLE energy ETF, I actually shorted USO. Okay, now I told members about it, and I warned them that at least for right now, it may not be wise to get into the USO ETF as a long position, but I shorted it, or rather bought an option put on it. And I'm trying to find the screenshot of where I did it. But for the most part, as of Thursday or Friday, it was up, I think, 15 or 20%. Okay. So again, knowing what to do, and knowing, when to pick up which particular asset is something that this community, Alpha Trades community, provides you. Okay. Now, even on Twitter, I got this message from one of the users that stated that, hey, I picked up this USO ETF at 446, and what do you think it'll do in a year? And with obviously my non-financial advice, I simply told this person that it's very possible that the USO ETF could get delisted, or it could actually go to zero, because there are too many oil tourists that are speculating in oil in an industry that they know nothing about, other than the fact that it is quote unquote cheap because it's $2.50. And people think that, well, obviously oil is going to go up in 2021, but they don't understand that USO as an ETF has nothing to do with the consumption, the usage, the demand and supply of oil. It's simply just really a speculative ETF that purchases the most near-term forward contract of oil futures. So these are the things that we implore in terms of research to our members, and show them how we're taking positions in the market, what we stay away from, what we buy into, what we short, etc. Okay. Now, building off this, Faisal, I obviously want to implore to people they do their own research in USO, but I also want to show people that the greed behind what's happening in things like USO is actually prevalent in other parts of the market. I think this is visible by a couple of the different screenshots that I have retweeted on my Twitter. Number one being the QQQ NASDAQ Power shares right here. Right? You can see again on Robinhood, people have held through, or almost rather added to their position in the entire drop of March, and even now on Robinhood. Okay, that's QQQ. And then even SPY right here. Okay, the Spider ETF, again, more and more users are still holding. Let's add some more to that. Okay, Tesla, same thing. Users, again, that's a green line right there. More and more people are holding the Tesla stock. IWM, which is the Russell 2000 index, or the ETF, again, more and more people are holding. Google, right here, more and more people are buying or holding. And then last but not least, XLI, which is the industrial sector, more and more people are buying or holding. Now, what I want to explain to people, and I want Faisal to touch upon this topic, is this kind of shows you that the greed and the directional positioning of most average retailers, which is that their mentality of buying the dip or buy and hold perpetually is going to blow up in their face at some point. And I think watching stats like this, kind of just people buying into these long positions and perpetually holding, is basically a ticking time bomb. And I'm going to let Faisal explain and expand upon that.
Yeah, first and foremost, when you first showed me these graphs, I was so surprised. I remember thinking to myself, I think I even said on the video, I don't expect people to even think about buying stocks during this period because it'll be a sort of wartime period, a very stressful period for American families and the globe around the world, where people would not be focused on investments and growing their money, but rather saving it for emergencies or anything that they need. I was totally wrong. Jeez, I was so wrong. And I think, sure, you can say that maybe these guys are playing it for the long run, but the amount of buying that has been this high, even as we've progressed through this coronavirus event, is just insane to me. And I think it really adds a lot of risk. This is Robinhood users, right? This is only
Yeah.
Robinhood. Yeah, so these are primarily retailers, and usually it's these people that end up not timing the market right. And so when you see them consistently buying, I think, sure, it is only a ticking time bomb till something bad happens and they end up liquidating their positions extremely fast or maybe too late. These institutions may be getting out now as these retailers are getting in. So there's a lot of ways to read it, but I'm just still so surprised there was this much retailer buying during a crisis like this.
Yeah, and it definitely surprised me a lot too, because especially when I started to come across USO, I thought, well, USO is definitely a ticking time bomb. So I expected a lot of users to be, positioned in the wrong direction. But then I saw Tesla and Google and IWM and the Spider ETF and then QQQ. All, I mean, you could go across the board, whether it's Nike, whether it's Facebook, everything, users are just holding. And this kind of leads off into the next topic, which is possibly, the flushing or maybe the liquidation of all of these, number one, over leveraged ETFs, and number two, retailers who are still, I don't think they've really felt the pain of what bear markets can really do to people, which is just a grinding, perpetual, red candle after red candle, sell side day after sell side day, every single day for weeks on end. And then they finally feel the pain and they sell pretty much at the absolute bottom. And so for that reason, I actually think that because there's so many people positioned, in net long, what seems to be net long, it seems like the market really, really hasn't made that next big drop, where I think the real fear and the real flushing of all these people will happen. And this is why I continue to believe that there's at least one more leg down. And if that leg down is even something like this, where it's like a W bottom, I would probably say in this next phase down, you might see, maybe users finally capitulate, whether it's on Robinhood or your average retailer is just too scared to buy. It actually might be possible, where we make another leg down and put in a lower low as for this area. But I do believe that there's a higher possibility, just based on the fact that every single person, my friends, my family, everyone keeps asking stocks are low and should we buy? And I think that's what scares me most, is that all these people, there's no possible way that these are the people who are going to be right about picking the bottom. What are your thoughts on that?
I totally agree. It's a really risky time when everyone wants to buy, especially people who don't have any market knowledge and are only looking at the headlines. It's really a risky time when they're just clamoring, saying, I'm willing to throw anything right now, even though they're in lockdown mode. They can't even go out and they're like, we got to buy stocks now. It's a different mentality. And I think it's different than every other single scenario that this type of rapid buying has happened. You talk about 1999, 2000. People were clamoring, asking what to buy when the market was at all-time high, when these internet stocks were already like super high. Same thing with the 08, 09, or the 08 rise, 07 rise. People were clamoring which banks to buy, which housing companies to buy when they were already at premium prices. Now we're seeing people saying which stocks to buy when they're kind of at depreciated prices. It's a really strange, different of events that I think is playing out, partially playing out in how this market is trading day by day, and why there is so much consistent um, retailer optimism to hold stocks, even though the news consistently gets worse outside. Um, I think it just comes from a different mentality from that perspective. But like you said, I still believe that the market has some more downside to go. But I watch the market every day, and I'm consistently more so betting on the short side than long side. And it surprises me every day how much strength I see in market leaders and stocks that I would expect to go down. There is a ton of strength, I don't think it's just retailers providing the strength at all. I don't think they could provide this amount of strength. You definitely have a lot of big institutions buying. And like I touched on before, a lot of these institutions don't just play for 1 year. They're looking at 3, 4, 5, 6 years. So if they really feel like this is a short-term scenario that's starting to get cleared up, that's definitely a reason to buy some of these assets that are still trading, 20% from their highs, 30% from their highs.
Yeah. One thing I wanted to mention to our viewers is that building off your point about, number one, obviously, retailers are not probably the only ones that are providing the fuel to the market. Obviously, it's the Fed, and also it's the institutions that are pretty much looking at the Fed and they're saying, well, it looks like, if the Fed's buying, we're buying too, which is, in its simplest essence, of course, you'd want to follow the Fed, which is, effectively the largest, most powerful agency that can actually help prop up the markets. But I think what scares me about that is we haven't quite learned from our lessons of some of these companies, which were never really supposed to be valued where they are. And I think that's a lot of companies. I was reading some stats about the S&P 500, and the 500 companies in the index spent about $7 trillion on buybacks and dividends since the 2007-2008 financial crisis. Only 1/3 of them actually put money towards research and development.
Mm-hmm.
So, I think what scares me about this is that I think America as a corporate culture has really become complacent on understanding what is real growth versus buyback and dividend growth that's actually fueling the stock to keep moving. Because for our viewers, what you need to understand is that a stock's price is actually incentivized to move up based on the decisions of how the company itself and executives behind it, which is that if the CEO and the board itself push up the price of the stock, they're actually compensated more money in terms of their bonuses. This is where they get their, private jets. This is where they get more return on their own shares that they own. And the real people who actually believe in the company, who think that it should be valued at X, Y amount, those are the people that are caught left holding the bag. So it's in fact that the executives and the board, and especially even the shorter term hedge fund managers and institution, force some of these companies to effectively keep moving their stock up, whether it's by buying back shares or dividends. And you could see this being reflected in the inflation of the stock itself. And I think this is really the crisis that is still impending, in my opinion. And this is a school of thought that's been well talked about by famous investors like Ray Dalio or Chamath Palihapitiya and many others, even Bianco Research. And I do believe that ETFs, specifically since the 2007-2008 crisis, have gained a tremendous amount of money from the private institutions as well as, your average retailer. Because it's very simple to understand that, if I buy this ETF, I'm basically buying a basket of these companies. So your risk is diversified, but what you don't understand is that the basket of the companies themselves in the ETF may already be overvalued. Thus, the ETF is overvalued. So my point is that I think the S&P 500 and many of the companies, as per this famous indicator that we've talked about before, is that total market cap over GDP, you could still see that the ratio still says that this is significantly overvalued. And so that goes to show that it just doesn't make any sense to me why the market itself is still continuously moving up. And specifically, companies like, if we're looking at AMD, which is pretty much back to its pre-COVID levels, Amazon, which has now hit all-time highs, like I understand that these are great companies, but are they companies that have actually done better than they did, pre-COVID? And are they expecting their revenues to increase in the next 12 months? And to me, obviously the answer is no, but I'm not going to um, I'm not going to fight the fact that the Fed is behind this. The larger institutions are pretty much pushing their money to drive up these stocks because maybe the books themselves are just so thin that there's maybe just not sellers left in the market, and rather it's just buyers constantly pushing up the price. What are your thoughts on the overvaluation of the S&P 500 companies? What do you think about buybacks and dividends, and then stocks like Amazon or AMD or ETFs in general, Faisal?
Oh man, this is where I come in. I'm glad you touched on the overpricing of the market. I'll get to that in a little bit though. With buybacks, I think you're totally right. It really has kind of changed the way companies kind of present themselves and put their values first. It's always shareholder value and which comes first. And I think ultimately we're moving away from that type of mindset. You look at a lot of companies like um, I think Salesforce and even Facebook, they're really trying to move away from that, albeit they're still very big companies and they still do a lot for shareholders. This type of shareholder first mentality is slowly dripping away, but I agree. It's really kind of created this inflated stock price environment where you don't really know the true value of the company. You only know the value of the stock. And I think there's a disconnect between that. Um, Touching on the pricing of the market. Now, here's the deal. Like you could say, sure, these companies, like how can AMD be trading at pre-COVID levels when I think it's expected to regress earnings by like 10% this year or something like that? Um, how could that happen? I want you to take a look at this company that I've been talking about a lot on the Discord, Okta. So Okta is a great company. It was a great company before the coronavirus hit. They're a software company, and they were really leading in their space.
Is it? It's
OKTA. OKTA.
Oh, okay.
This stock broke out. Okay, this stock is trading at like a 300 PE. This stock will not have positive earnings until 2022. Okay, they're not even going to be profitable. They are so expensive.
Wow.
This year, their earnings are regressing 20%. Okay, and this stock just made an all-time high. What does that tell you? What does that tell you? That tells you people are looking way further down because the growth rates for 2021 to 2022 is still good. This stock was a high flyer, high grower, had great technology behind it, and you're seeing investors put money where their mouth is and actually buy it now for those future earnings. So I think it tells a lot about the type of environment we're in, and it's a really healthy sign when you see companies this expensive and this um, kind of fragile. You would think fragile, they would be the most at risk for economic recession. Um, and their earnings are regressing this year. So yeah, they are getting hit, but people are willing to buy them even at these prices because this stock could probably be worth $200, $300 in 2 years, 3 years to them. So why not buy it now? And I think that's what you're going to see. We are in an environment where there's consistent winners and there's consistent losers. And I think it's all about the companies that are able to maintain high growth rates or expected high growth rates for 2021 and 2022, because that's where the big money is trying to play right now. They are looking beyond just 12 months out because everyone's cutting guidance this year and a little bit of next year. I think that's already known. Now it's about beyond that. And you've seen with Okta, like they are really pumping this stock up. I mean, to make an all-time high now is crazy in my opinion.
Great point. Now, obviously, I think one thing you and I both agree upon is, some of these companies definitely should not be worth where they are. Now, we can't do anything regarding how the market's moving. Obviously, we can discuss that this company should be priced a little bit lower or the market is clearly moving irrationally, but it doesn't matter what we think. The market is going to do what it's going to do, right? If we move over to the bond side, which is really where people need to understand that that helps you really understand how the bond markets are factoring in what's happening in the underlying economy, as well as the markets as a whole. And the bond markets are significantly larger than the equities markets. Now, the 10-year Treasury note has consistently, gone down over the last several weeks, even as the equity markets have been going up. Now, this is one chart that I showed our members, is that if we just turn this to a different color, okay, and we look at the 10-year Treasury note, which is right here. I'm sorry, right here in the black, and you can see the equities markets going up. The bond markets have completely just, regressed further. Now, I did a comparison of what happened in 2008, 2009 financial crisis, okay? And if we look back here, okay, you could see that the bond markets and the equities markets actually reversed together. Obviously, the bond markets, especially the 10-year, kept going down, over the last several years, and then moved up with the market right here around 2016. But again, right here around 2018, completely just started to fall off, and yet the equities markets kept going up. Now we're again in that same phase where there are divergent movements of the equities markets consistently going up, even in the face of recession as well as layoffs across the board, yet the bond markets are going down. We also had news recently that the Fed might be taking interest rates to negative next week, as early as next week. Faisal, I'd like you to sort of explain to us, what are your thoughts, number one, on the bond markets, and also, number two, the interest rates going to negative next week?
Sure. Well, first and foremost, I'm not a bond expert, so take that for what you will, but I am somewhat knowledgeable about how these things affect the overall equities market. The reason why, you spoke about in 2018, yields started to come down, yet the market rose, that was considered a very positive scenario because the Fed was not seeing its inflation target. Like, inflation was not rising to the level where Feds needed to raise rates or anything. And so they actually, ended up cutting rates minimally. And even though it was in result of the trade war, which didn't end up taking that big of a toll on us in hindsight, rates ended up coming down and the market just roared. They loved that because it was considered this short-term juice that it really needed. I think Goldman Sachs said it was a Goldilocks era because you would have this level of inflation, these low of rates, and this high of economic growth. So that part makes sense. As far as the interest rate, with the yield continuing to go down and now interest rates potentially going to negative, I think, look, I don't really know the implications of going negative at this point, what it will have in the long run. But I think, the Fed is showing you, as long as the Fed's showing you it's willing to do whatever it takes to ease people and to ease the business stress, and they're willing to act fast. Like, if you're telling me next week, dang, that's really fast. That's really positive for the market. I think the market will take that in stride in the short term as the Fed reacting exactly when it needs to. And I still think long-term wise, we don't know what this means for our economic structure or how we can go back to business and be able to use debt as an instrument in the future.
Yes. And one thing to note on that is the fact that we keep consistently talking about how easy it is for money to be created and generated due to the Fed's intervention. I think the one point that most people are missing is that the multi-quarter recovery, the time that it will take for the US economy to recover, it's not going to be like a fast snap of the finger. It's going to be at least 1 year to get all these 26.5 million people back in employed. And you might still see rolling bankruptcies across the board into the end of 2020 and beginning of 2021, because some of the stipulations of the Fed giving out bailouts is that companies are not allowed to lay off people right now. I think by Q4, those stipulations might be lifted and they might be going through, packaged bankruptcies where the company itself may get dissolved or become insolvent, and either whether you talk about airlines or companies across the board, they might be restructured, rebranded. They might even be nationalized because the Fed itself pretty much owns, pieces of the company or large chunks of it. So there are larger implications that are at play when the Fed has this kind of overarching intervention in the market. And I think people are not realizing that this kind of intervention, though it might be positive for the shorter term, the longer term implications are possibly, and if we have learned anything from history, whether it's Japan or making money cheap or basically creating an MMT environment where it's modern money theory of helicopter money, giving money to everyone, it doesn't end well. It's never ended well for any of the previous nation states. It hasn't ended well for empires, and more than likely, it's not going to end well for the U.S. because what we're really doing is we're creating more debt. We're rewarding companies for being fiscally irresponsible, when in fact that this crisis should have been the crisis of empowering more small businesses and giving people the money. Or rather, what we've really done is the companies, like I've showed you guys before, where $7 trillion of that money that went for buybacks and dividends, some of these companies are the same companies who bought back their own stocks, gave back the dividends, are the same ones who are now, with hands out in front, asking Congress and asking the government for a bailout. So this is where the whole idea of capitalism sort of crumbles before your eyes, because the idea of free market has completely evaporated. And you start to realize that, while it looks like the priorities of the government are pretty clear, that they're going to do whatever it takes to push the market up, the stock market, keep corporations alive, even though they were, again, fiscally irresponsible, and yet the people are still suffering. Now, I know, Faisal, you said that people are still, obviously getting their unemployment checks, but would you agree, I guess, that, if you gave people enough money, or if you made maybe, small business loans cheaper for people to start their own businesses, do you think that would have been a better way to go about this whole handling of this process? Or do you think that money was better spent in terms of backstopping, the bond markets as well as the equity markets?
That's a good question. I don't think we've reached enough time to really determine which one has been better, or which one, if one was wrong option or not. But I will say it just all depends on when the reopening of the economy is, because if this lockdown period extends, to the end of the year, obviously that's not going to be enough, and that's not a good problem. And there should have been much deeper solutions rather than just giving people some checks. But I think as far as the timeline goes, I think this was always, even at the start of the crisis, I think governments like Texas were always planning on reopening early. And I think it all just entails to that. Like, I think the solutions we have now are fine if the problem remains very short term and can be fixed within 2 weeks to a month. But if not, then no, we're going to have to go back to the drawing board and figure else or something else out.
Yeah, that's a good point. And I want to expand upon my bond explanation earlier real quick too. Here are two companies that Hertz and Avis especially, obviously Hertz's bond prices have completely just, collapsed. That the floor is just, completely just dissolved. And you can see respectively from the 2014 market cap levels, they're basically, almost 1/10 of what their height used to be. And this is actually the case of a lot of companies, especially companies being downgraded from the triple B status, which is just one level, above the junk bond status. And I think we saw a lot of bond downgrades by the S&P and Moody's last week. And I think Hertz was probably one of them. Ford was another one. There are many other companies associated with that. So I think point is, the unfolding of this process is still a day by day, week by week thing. And my point to people is that though you see the market going up, I want people to pay attention to what the numbers are showing, whether companies are declaring bankruptcy, where the bond prices are, what bonds specifically, which corporations are getting downgraded. I was reading just recently that Gap itself was asking for a $5 billion bond raise. which again didn't make sense to me because first of all, who the hell shops at Gap? And if they do, I mean, is shopping at Gap really the one company that we need to save, or is the money better allocated to, maybe more forward and progressive thinking companies, maybe like Amazon or more online retailers. So this is the kind of world that we're in where when we go through market cycles, and Faisal and I have talked about this before, when we go through market cycles like this, you should ultimately see industries, multiple companies in particular sectors being completely just being wiped, because that's the natural process. That's the natural order of life in market cycles. Yet, unfortunately, when the Fed says they're going to step into the HYG bond markets, or they're going to backstop any slides in the ETF markets, this scares me, because what you're really doing is you're rewarding bad behavior. And I understand that you need to do things to save the economy. But again, the question is this the right thing to do to save the economy? And again, this is a question that none of us really have the answer to, but we can all debate and speculate.
Yeah, I
Now,
mean, I don't really think it's kind of Fed rewarding bad behavior, because remember, these companies, sure, they may have look bad now saying, why did you take out so much debt and do all that? But beforehand, before this virus, I think no one predicted a scenario where your employment would have to not come to work. Like, even though you could be selling product and doing good in relation to, if you were about to go bankrupt because you were selling bad product and doing bad, and slowly and surely you have to cut employees and your business diminishes. That's the main reason why I think the Fed has to step in, and why it's more necessary than usual, because it's just a sudden cut. And I think it's just such an unexpected scenario for companies that even have like somewhat debt, that were fairly healthy before, but now it's looking like, hey, with no customers coming in and our debt having to be paid off, like, we need any money we can get. I think that really prompts the necessity of the Fed. So I think it's more of a necessity play than kind of bailing out the bad dudes, in a sense.
yeah. Well, so here's another example that I wanted to give you, Faisal, is if you look at the company IBM, although it's a great company, but as per the numbers, it really looks really bad.
It's a bad company. I don't
Now,
like it.
yeah, it's a terrible company, especially when you start looking at the last 10 years, where their innovation has really just gone to crap. And even their stock valuation, again, this goes back to the same example that we spoke about regarding buybacks and dividends.
Yes.
IBM had a CEO that was in charge of the company for 24 declining consecutive quarters.
Hmm.
Yet she was able to make millions of dollars because she was able to buy stock buybacks for about $140 billion over the last, I think, 11 years or so. And guess what? Their company was only now, or I guess now it's a total of $100 billion in market cap. So buying back $140 billion worth of shares, having 24 consecutive declining quarters, yet your CEO makes millions, your board makes a lot of money. This is not what corporate America is supposed to be about. And I think this is where we have to go through a real rebuilding of America, rebuilding of corporate America, where we understand that there should be some punishment for bad companies. Now, obviously, I don't think IBM is out there asking for bailouts, but there are many companies like IBM, like I showed you earlier, where about 500 of the S&P 500 index companies, they all went through about $7 trillion on buybacks and dividends. So I'm pretty sure there's a lot. I think there's about 90 companies, I think I read the stat, that are asking for some bailout or a complete bailout from the government in the S&P 500 alone, which is a very scary fact, because again, this goes back to the point of what do we need to do to change the behavior of some of these companies to actually start acting fiscally responsible? Does it just completely mean that you need to stop doing stock buybacks or dividends? I was reading something by Jim Bianco where he mentioned that back in the 40s and 50s, number one, I mean, there was no such thing as bailouts, right? And if there was like a CEO asked the company or asked the government for a bailout, the government itself would drag you to court and they would say, how could you have been so fiscally irresponsible, and realize that were running a failing company. Now you're asking us for a bailout. And I just don't think we've seen anything like that over the last several years. We consistently keep handing out money. And I personally believe that, we keep rewarding bad behavior. But again, to each his own. Maybe you don't think that yet, but it just seems to me that, the fact that we're already thinking about bailing out airlines and companies across the board, it just really doesn't seem to me like we've learned from the lessons of 2008, 2009 financial crisis, or even, the dot-com bubble.
Yeah, I think companies were a little bit different. This recession is just totally different than those, on the fact that the ones that crashed in 08, 09 were heavily risky, heavily debt ridden, and same with 2000. I think the level of risk between those assets before the correction period is spectrum's different. I think now you still have companies that are not totally debt ridden. I love that you brought up IBM. IBM, I don't even know how much debt they had now, but they had a ton of cash and they completely blew it on dividends and buybacks, exactly what you said, when they could have been reinnovating the entire tech space. They had the most cash out of anyone in their heyday. And so, I really hope they really should be the last company to ask for a bailout. But, I really want to see how this thing plays out. If we really start to see more and more huge companies ask for bailouts, sure, then I think you can definitely bring up the whole fact that these guys may just be really fiscally terrible, and maybe they deserve to go under, some of these huge companies. I don't know, but if we come to that point, I guess we'll review over it.
Exactly. Last but not least, folks, just two more topics that I want to touch upon, and then I'll let Faisal talk about some of the things that he's been doing for the Alpha Trades community. The ECB, again, is also following the Fed, which is it's stepping into the junk bond area and backstopping any slide in that particular market. And the reason that's an important area is because if you start seeing these junk bonds start to roll into insolvency phases, or these junk bonds effectively being thrown on the open market, no one wants to buy them, you'll start seeing bankruptcies pile up. You'll start seeing these bankruptcies and this insolvency being written on the books of banks. And if banks start incurring this kind of defaults on their balance sheets, you're going to start seeing banks breaking down. So this is like a real, domino effect that the ECB as well as the Fed is trying to stop. So if you're wondering why is it important that the Fed is trying to step into the junk bond market as well as the ECB, well, this is the reason. Now, last but not least, my final topic is the other implosions that are happening around the world, specifically regarding obviously the Eurozone, which I just mentioned, as well as the emerging markets such as Brazil, Argentina, and other markets in Asia. What you're really seeing in some of these markets, specifically Brazil, is you could see that their stock market last week was completely just collapsing. And you could see also their currency, the Brazilian real, right there, took about a 10% swing up against the dollar in just 1 week, or less than a week, actually. And so it moved up about 9.9%, as you can see. So the reason this kind of information is important is because remember that pegging your currency against the dollar and understanding that there's a lot of dollar-denominated debt in these emerging markets is a critical piece of information that people need to understand, because when you have dollar-denominated debt and your currency is getting weaker against the dollar, that means it's even harder for you to pay back the debt because the dollar is continuously gaining strength against your currency. So the reason you're starting to see these emerging markets break down is because, number one, the dollar is getting stronger, but number two, because the world itself has had a lack of demand, economies are being shut down, EMs specifically are the most vulnerable, okay? And specifically, Brazil and Argentina are really starting to come to the brink of their currencies collapsing as well as their stock markets collapsing. So just something you guys may want to pay attention to. Now in our community, we've done a fantastic job of laying out landscape of how we're continuously trading the dollar against emerging market currencies and longing the dollar against EMs, or shorting euro or Aussie dollar against the US dollar. Okay, so last week we actually had a fantastic trade of closing from 1087 and catching that trade down to about 1077. That was about 1,000 pip move. And this is all available in our Forex chat right here, which I run. And you can see right here, I closed out my position 1077 right there. And this was entered right there at 1086. So this is the kind of information that we provide for our community on a day-to-day basis. Okay, so if you're interested in Forex, if you're interested in talks like this with me and Faisal and with his updates that you see on a day-to-day basis, right, come join the Advantage program. Now, I'm going to leave it to Faisal to discuss a couple more things that he's been doing with the community and a couple other topics that he wants to talk about.
Yeah. So starting Monday, we added a couple of new channels to the stock market side. So I'm going to be doing a little bit more work as far as getting some quick information to you guys to where you don't have to read through all my commentary throughout the day. Some people don't want to read, and I totally get that. But I still want to give you guys some information to maybe think about or to potentially trade off of, because I really do have some fantastic ideas sometimes, and I think I can get in at the really good times. So I wanted to bring back stock alerts for those of you who were with the community last year. I was there for a brief period of time, and I did start off doing stock alerts, and I've had some people mention for me to bring it back, and I'm finally bringing it back now, but this time we're going to add a track record so that you guys can really see the level of success that these alerts have. Because like I said, I think I'm pretty good, and I think these alerts will definitely reflect the success of my trades and overall ideas.
Can you give us
Next,
an explanation? Sorry about that. Can you give us an explanation of how this is going to play out? So is it going to be like, I'm seeing, let's just say, for example, Apple's earnings are coming out. I'm expecting positive results. I'm going to enter here and think about placing a stop here. Is that what you mean?
it won't necessarily be based on earnings. It could be based on earnings. I'll kind of let that know. It could be based on a number of factors. So I have my own technical and fundamental criteria that I use to pick out my own trades. There are times where I cannot invest in every idea, but I still think they could be fantastic opportunities for people who believe in that sector and believe in that idea. And so I just want to give, alerts saying, hey, if you had your eye on this stock, fundamentally, it still looks great. Valuation still looks fine. And technically, this is where I'm seeing the momentum start to build. So I really think that these will be really useful. And for those of you who just kind of want a quick pick on how exactly I can gain information from alpha trades in general, this is an area that I would try and, look at, because every day I may come up with 2 or 3 different ideas that I kind of think is interesting, and I'll work through them and update them as time goes along, whether I decide to cut the alert or it reaches the downside stop target and I have to void the alert. It'll be a whole process. You won't feel like abandoned. It'll be updated from the start of the alert to the finish of the alert, and that whole process will be transparent with you guys.
Perfect. And what are the other channels?
And then, so the other one is stock of the day. So usually there's about one stock that day, whether it looks somewhat attractive to me or it just has some interesting information or some pull on the market. I will go over that stock and technically go over what I'm looking for, and then give kind of a whole synopsis on whether or not I like the idea or I think it's tradable or something like that. It was just a kind of quick snap, technically and fundamentally, on just one idea. And then top growth stocks, that's the last sector or the last section that I'm going to cover. It's going to be a list of 10 to 15 growth stocks that I consider fundamentally great and technically great. So kind of like my alerts, but this one is going to be just a list primarily comprised of growth-oriented equities. So mostly in the tech sector, sometimes in the retail sector. They're going to have to meet my specific growth criteria factors, and my specialty is growth stocks, specifically growth tech stocks. So keep an eye out for that if you're someone who likes volatility and likes investing in technology as well. But yeah, those are kind of the three main topics that I wanted to give you guys some more information that's quick and easily accessible and not so much reading. I know I can write a lot and type a lot. So I hope you guys kind of enjoy this form of information, and let me know if there's anything else that I can do as far as improving the type of information you get and whether or not it's still too much to read or you want it to be shorter. I'm open to all types of ideas. So feel free to DM me on Discord and we can talk about that for sure.
Perfect. I think one thing that we really do well in our community is we consistently do whatever it takes to improve and keep adding value and content. And I really hope people who are watching this right now can see the vast amount of information that you provide on a day-to-day basis regarding what you're seeing in the market itself. And now that you're adding these stock alert channels and stock of the day or top growth stocks, I think is going to add tremendous value. So for those of you who are watching this right now, go to the Cryptosomniac website. Again, we are formerly known as Cryptosomniac, but now we are known as the Alpha Trades community. Okay, and you could go to the Cryptosomniac website, hit the products page right there, and buy the Advantage subscription, because starting May 5th, we're going to raise up the prices from 97 to 125. But if you're paying right now and you're grandfathered in, you won't have to pay that increase in price. You can see Faisal puts in a lot of work in his content right here. I put in a lot of work in the Forex side. Faisal also does updates in the oil channel as well, in terms of the commodities channel. And then of course we have crypto, where we take a ton of positions as well as do a lot of analysis on a day-to-day basis. Okay. Well, with that being said, Faisal, is there anything else that you want to talk about?
Yeah, there was just some quick things that I wanted to get over before we go, just so that you guys are aware for the week. So as you guys know, this is earnings season. So there are a lot of big companies reporting this week. I kind of factored out a couple, so keep on a lookout. If you have these stocks, make preparations, look up when exactly the earnings date is. I'm not going to give you the exact date, but it's sometime this week. So Amazon, Apple, McDonald's, Microsoft, Tesla, Boeing, Cat, Facebook, Qualcomm, Google, Starbucks, United Airlines, and Visa, and a lot more big companies. That was just my initial list. A lot of them are reporting this week, so make adjustments if you have them. Adjust your risk, whatever. If you want to play the earnings, go ahead and play them before the date. And then also, I wanted to give you guys just some tidbit of information to look over this weekend for tomorrow. I wanted to do something different for the videos, maybe give you guys some information right at the end to look up. So I'm going to do one long and one short for the week. My long of the week is Medtronic. I think technically it looks good, and the sector has shown me a lot of momentum after who reported last week? EW reported last week, and I forgot another medical technology device. I forgot, but the sector, bottom line, the sector looks great, and Medtronic looks primed to continue its uptrend. Also, it's benefiting from, making ventilators for this whole crisis, as that demand is still high. So I think that's a really good pick with some secular momentum. And my short of the week would be XRT, which is a retail ETF that's mostly comprised of a lot of department stores like Dillard's, Macy's. They make up a lot of that portfolio, but they also have a lot of auto dealers like CarMax and O'Reilly, which is the auto parts. They're really mixed into the entire retail space. And I think a lot of their assets in their portfolio have seen a nice bump recently, but technically I think they could start to see some momentum being dropped. So XRT would be my short to watch of the week. I think that sector will probably be one of the worst this week. So these are all my opinions. This is not investment advice. This is just something, you guys can look up after, explore with your own technical formulas, your own fundamental formulas, but these are just my ideas that I'm looking at for the week. So I hope you guys find some value in that.
Awesome. I think that's great information, Faisal. So people should look out for XRT as per Faisal's information about a short. Again, not financial advice. And then Medtronic was the long position that he was considering. Okay. Well, with that being said, thank you always so much for watching our videos. Give us a thumbs up, hit the subscribe button, or join the Advantage membership for this kind of information. Obviously, like you see, all these locked channels are for our paid members, whether it's crypto, whether it's equity side right here, Forex and oil, a ton of information, and then obviously options as well down here. Tons of information that we provide to our Advantage members. And I hope y'all come join. And till then, we'll see you next week. Cheers.
Peace.